Question 1. Governance review demonstrates that the risk assessment process for the Oracle financial consolidation and close implementation is primarily focused on documenting existing controls rather than identifying potential future risks to the accuracy and timeliness of the financial close. Which of the following approaches best addresses this deficiency and aligns with best practices for financial reporting integrity? Option A. Conduct a comprehensive retrospective analysis of all financial misstatements identified in the past 3 fiscal years to understand the root causes and update documentation accordingly. Option B. Develop a generic risk assessment template that can be applied across all financial systems, ensuring a baseline level of risk identification for the organization. Option C. Implement a continuous risk assessment framework that integrates with the financial close cycle, focusing on identifying, evaluating, and mitigating risks associated with data inputs, system configurations, and consolidation processes within Oracle FCC. Option D. Schedule a one-time risk assessment workshop with the project team to document all known risks at the current stage of the Oracle FCC implementation. The correct answer is C. Implement a continuous risk assessment framework that integrates with the financial close cycle, focusing on identifying, evaluating, and mitigating risks associated with data inputs, system configurations, and consolidation processes within Oracle FCC. Explanation. Scenario analysis. This scenario presents a professional challenge in a financial consolidation and close process, where a governance review has identified potential weaknesses in the risk assessment approach. The challenge lies in ensuring that the risk assessment is not merely a procedural exercise, but a robust, forward-looking mechanism that effectively identifies, evaluates, and mitigates risks impacting the accuracy and timeliness of financial reporting. The need for careful judgment arises from selecting the most appropriate risk assessment methodology that aligns with regulatory expectations and business objectives, especially in the context of Oracle financial consolidation and close FCC implementation. Correct approach analysis. The correct approach involves a proactive and integrated risk assessment that is embedded within the financial close process. This methodology, often aligned with frameworks like COSO, emphasizes identifying risks at various stages of the close, assessing their likelihood and impact, and designing controls to mitigate them. For an Oracle FCC implementation, this means understanding how system configurations, data inputs, intercompany processes, and consolidation rules can introduce risks. A strong risk assessment will leverage data analytics, process walkthrough, and expert judgment to identify potential misstatements, control deficiencies, or delays. This approach represents best professional practice because it directly supports the integrity of financial reporting, which is a core regulatory requirement. It ensures that management has a clear understanding of the risks to the close and has implemented appropriate responses, thereby enhancing the reliability of financial statements and supporting compliance with relevant financial reporting standards. Incorrect approaches analysis. One incorrect approach is to rely solely on a retrospective review of past errors. This is professionally unacceptable because it is reactive rather than proactive. Regulatory frameworks, such as those underpinning financial reporting integrity, expect organizations to identify and address risks before they manifest as errors. A retrospective approach fails to prevent future issues and does not demonstrate a commitment to robust internal controls. Another incorrect approach is to conduct a risk assessment that is disconnected from the actual financial close activities and system functionalities. This might involve a generic risk assessment that doesn't consider the specific risks inherent in the Oracle FCC application, such as data integration issues, incorrect mapping of accounts, or inadequate segregation of duties within the system. Such a disconnected approach is professionally deficient, as it fails to identify and address the unique risks associated with the chosen financial consolidation tool, potentially leading to inaccurate consolidations and non-compliance. A third incorrect approach is to treat risk assessment as a one-time activity performed only during the initial implementation of Oracle FCC. Financial reporting environments are dynamic, with evolving business operations, regulatory changes, and system updates. A static risk assessment quickly becomes obsolete. This is professionally unacceptable, as it fails to adapt to changing risk landscapes, leaving the organization vulnerable to emerging risks that could impact the accuracy and reliability of its financial statements. Professional reasoning. Professionals involved in Oracle FCC implementation and financial close processes should adopt a risk-based approach to their work. This involves understanding the business objectives, the regulatory environment, and the specific functionalities of the Oracle FCC system. The decision-making process should prioritize identifying risks that could materially impact the financial statements. This requires a combination of understanding the business processes, the technical aspects of the system, and the relevant accounting and regulatory standards. A continuous risk assessment process, integrated with the close cycle and system updates, is crucial for maintaining the integrity of financial reporting and ensuring compliance. Professionals should actively seek to understand the what-ifs and develop mitigation strategies, rather than simply documenting existing processes. Question 2. The control framework reveals that during the implementation of Oracle Financial Consolidation and Close, FCC 2020, the project team has primarily focused on the functional aspects of data aggregation and reporting, with limited attention paid to the comprehensive identification and evaluation of potential risks related to data security and regulatory compliance within the cloud environment. Which of the following approaches best addresses this gap in the risk assessment process? Option A. Assume that the cloud service provider's standard security measures are sufficient and focus solely on user training for the FCC 2020 application. Option B. Limit the risk assessment to only those risks that directly impact the speed of financial data consolidation, as this is the primary objective of the FCC 2020 implementation. Option C. Prioritize the completion of the functional implementation timeline, deferring a detailed risk assessment until after the system has gone live. Option D. Conduct a thorough risk assessment that maps potential threats and vulnerabilities to specific FCC 2020 functionalities and cloud infrastructure components, evaluating their likelihood and impact, and designing appropriate mitigating controls in alignment with relevant financial reporting regulations. The correct answer is D. Conduct a thorough risk assessment that maps potential threats and vulnerabilities to specific FCC 2020 functionalities and cloud infrastructure components, evaluating their likelihood and impact, and designing appropriate mitigating controls in alignment with relevant financial reporting regulations. Explanation. The control framework reveals a potential weakness in the risk assessment process for a new cloud-based financial consolidation system implementation. The challenge lies in accurately identifying and evaluating the risks associated with data security, system integrity, and compliance with financial reporting regulations within the Oracle Financial Consolidation and Close FCC 2020 environment. This requires a nuanced understanding of both the technical capabilities of the system and the specific regulatory landscape governing financial data. The correct approach involves a comprehensive risk assessment that considers the inherent risks of cloud technology, the specific functionalities of FCC 2020, and the applicable regulatory requirements. This includes identifying potential threats such as unauthorized access, data breaches, system downtime, and non-compliance with reporting standards. It also necessitates evaluating the likelihood and impact of these risks, and then designing appropriate mitigating controls. This aligns with best professional practice by ensuring that the implementation proactively addresses potential issues, safeguarding financial data integrity and regulatory adherence. An incorrect approach would be to solely rely on the vendor's security assurances without independent verification. This fails to acknowledge the shared responsibility model in cloud computing and could lead to regulatory noncompliance if the vendor's controls are insufficient or misaligned with specific jurisdictional requirements. Another incorrect approach is to focus only on operational risks, neglecting the critical compliance and data privacy aspects. This oversight can result in significant legal and financial penalties, as well as reputational damage, by failing to meet statutory obligations for financial reporting and data protection. A third incorrect approach is to conduct a superficial risk assessment that does not drill down into the specific configurations and user access controls within FCC 2020. This leaves the organization vulnerable to internal threats and errors that could compromise the accuracy and reliability of consolidated financial statements. Professionals should approach this situation by first understanding the scope of the implementation and the critical financial data involved. They should then engage with stakeholders from IT, finance, and compliance to collaboratively identify potential risks. A structured risk assessment methodology, such as COSO or ISO 31000, should be employed to systematically evaluate identified risks. This process should be iterative, with ongoing monitoring and reassessment as the system is deployed and used. The decision-making process should prioritize the protection of financial data, the accuracy of reporting, and adherence to all relevant regulations. Question 3. Risk assessment procedures indicate that the automated intercompany reconciliation process within the Oracle Financial Consolidation and Close solution may not be operating effectively, potentially leading to unrecorded or misstated intercompany balances. Which of the following approaches best addresses this identified risk? Option A. Relying on the Oracle vendor's standard documentation and certifications that attest to the general control environment of the Oracle Financial Consolidation and Close application. Option B. Performing a high-level review of the overall financial close timeline and assuming that any significant intercompany discrepancies would have been identified by the finance department during their manual review. Option C. Reviewing the system's configuration settings and testing the automated reconciliation logic by performing sample reconciliations and examining system-generated exception reports and management's follow-up actions. Option D. Focusing solely on the manual journal entries made by the finance team to adjust intercompany balances, assuming the automated process is inherently accurate. The correct answer is C. Reviewing the system's configuration settings and testing the automated reconciliation logic by performing sample reconciliations and examining system-generated exception reports and management's follow-up actions. Explanation. Scenario analysis. This scenario presents a common challenge in financial consolidation and close processes where the effectiveness of internal controls is directly tied to the accuracy and completeness of financial reporting. The professional challenge lies in identifying and evaluating the risk of material misstatement due to control deficiencies, particularly when those controls are automated. The reliance on automated controls introduces a unique set of risks, including the potential for systemic errors, inadequate testing of logic, and insufficient segregation of duties within the system itself. This requires a deep understanding of both the business processes and the underlying technology. Correct approach analysis. The correct approach involves a thorough evaluation of the design and operating effectiveness of automated controls within the Oracle Financial Consolidation and Close FCC solution. This includes understanding the specific business processes automated by the system, the data flows, the control points within the application, and the IT general controls that support the integrity of the system. Testing the operating effectiveness would involve examining evidence of control performance, such as system logs, reconciliation reports generated by the system, and evidence of management review. This approach aligns with professional auditing standards and regulatory expectations that require a risk-based approach to identifying and assessing control deficiencies that could lead to material misstatements. It directly addresses the potential for misstatements arising from the automated close process. Incorrect approaches analysis. One incorrect approach would be to solely rely on the vendor's assurances regarding the controls within the Oracle FCC solution. While vendors provide documentation and attestations, these do not absolve the implementing organization or its auditors from performing their own due diligence and testing. Regulatory frameworks require an independent assessment of controls relevant to financial reporting. Another incorrect approach would be to focus only on manual controls that interface with the Oracle FCC system, ignoring the automated controls embedded within the application itself. This would overlook a significant area of risk, as automated controls, if not designed or operating effectively, can lead to widespread and systemic misstatements. A third incorrect approach would be to assume that the implementation of a reputable system like Oracle FCC inherently means all controls are effective without specific testing. This assumption bypasses the critical step of risk assessment and control evaluation, which is fundamental to ensuring the reliability of financial reporting. Professional reasoning. Professionals should adopt a risk-based approach, starting with understanding the business objectives and the financial reporting risks associated with the consolidation and close process. This involves identifying key financial statement accounts and disclosures, understanding the processes that impact them, and then identifying the controls, both manual and automated, that mitigate the risks of material misstatement. For automated controls within systems like Oracle FCC, this necessitates a detailed understanding of the system's configuration, the logic embedded in its processes, and the IT general controls supporting its operation. Testing should be designed to provide reasonable assurance that the controls are operating as intended. When control deficiencies are identified, a professional judgment must be made regarding their impact on the financial statements and the need for remediation. Question 4. Benchmark analysis indicates that organizations implementing Oracle Financial Consolidation and Close (FCC) often face challenges in ensuring their configured solution fully adheres to specific regulatory reporting mandates. Considering the critical importance of compliance, which of the following approaches best ensures that the FCC implementation meets all relevant regulatory reporting requirements? Option A. Prioritize the rapid deployment of standard FCC functionalities and address any specific regulatory reporting gaps post-implementation through manual adjustments or workarounds. Option B. Rely on general accounting principles and the system's default reporting templates, assuming they will adequately cover all regulatory reporting needs without explicit verification. Option C. Focus on achieving the fastest possible close cycle by streamlining processes, with regulatory reporting being a secondary consideration to be addressed if issues arise during external audits. Option D. Conduct a comprehensive review of all applicable regulatory reporting requirements with legal and compliance teams, and then meticulously configure the FCC system to directly map and report according to these specific mandates, followed by rigorous validation. The correct answer is A. Prioritize the rapid deployment of standard FCC functionalities and address any specific regulatory reporting gaps post-implementation through manual adjustments or workarounds. Explanation. Scenario analysis. This scenario presents a common challenge in financial consolidation and close processes where the implementation of a new system needs to align with evolving regulatory reporting requirements. The professional challenge lies in balancing the technical capabilities of the Oracle Financial Consolidation and Close (FCC) solution with the specific and potentially nuanced reporting obligations mandated by the relevant regulatory body. Misinterpreting or inadequately addressing these requirements can lead to non-compliance, inaccurate financial statements, and potential penalties. The need for deep understanding of both the system's functionality and the regulatory landscape is paramount. Correct approach analysis. The correct approach involves a proactive and collaborative engagement with regulatory experts and the internal compliance team to thoroughly understand and document the specific reporting requirements. This ensures that the FCC system configuration, including data models, consolidation rules, and reporting templates, is designed to accurately capture and present information in compliance with the specified regulations. This approach prioritizes adherence to legal and regulatory mandates, which is the foundational principle of financial reporting integrity. By validating the configuration against these requirements, the implementation minimizes the risk of non-compliance and ensures the reliability of the financial data. Incorrect approaches analysis. One incorrect approach is to solely rely on the default configurations and standard reporting capabilities of the FCC system without a thorough review against specific regulatory mandates. This fails to acknowledge that regulatory requirements can be highly specific and may not be fully addressed by out-of-the-box features. This approach risks overlooking critical data points or reporting formats necessary for compliance, leading to potential regulatory violations. Another incorrect approach is to prioritize the speed of implementation over the accuracy and completeness of regulatory compliance. This might involve making assumptions about reporting requirements or deferring complex compliance-related configurations to a later stage. Such an approach is professionally unacceptable as it compromises the integrity of financial reporting and exposes the organization to significant legal and financial risks. Regulatory compliance is not an optional add-on, but a core requirement of the financial close process. A further incorrect approach is to assume that general accounting principles are sufficient without verifying specific regulatory reporting nuances. While general principles form the basis, specific regulations often dictate unique disclosure requirements, presentation formats, or data aggregation methods that differ from standard accounting practices. Ignoring these specifics can lead to reporting that is technically correct under general accounting, but non-compliant with the governing regulations. Professional reasoning. Professionals undertaking financial consolidation and close implementations must adopt a risk-based approach that places regulatory compliance at the forefront. The decision-making process should involve 1. Thoroughly identifying and understanding all applicable regulatory reporting requirements. 2. Engaging subject matter experts, legal, compliance, and regulatory specialists early and continuously throughout the project. 3. Mapping these requirements directly to the capabilities and configuration options within the FCC system. 4. Conducting rigorous testing and validation cycles specifically focused on regulatory compliance. 5. Establishing clear documentation of how each regulatory requirement is met by the system configuration. This structured approach ensures that the implemented solution not only meets business needs, but also satisfies all legal and regulatory obligations, thereby safeguarding the organization's reputation and financial health. Question 5. The monitoring system demonstrates a discrepancy in the intercompany elimination process for a specific legal entity during the monthly close. The alert indicates a potential misstatement in the consolidated financial statements. What is the most appropriate best practice approach to address this alert? Option A. Rely on the system's automated reconciliation feature to correct the discrepancy without further manual review, as the system is designed to handle such issues. Option B. Escalate the alert to senior management for a decision on how to proceed, without conducting an initial investigation to understand the nature of the discrepancy. Option C. Immediately initiate a formal investigation involving the accounting team and IT to identify the root cause of the discrepancy, document all findings, and implement a corrective action plan, ensuring compliance with U.S. GAAP and internal control policies. Option D. Override the system alert and proceed with the consolidation, assuming the alert is a false positive due to a temporary system glitch. The correct answer is C. Immediately initiate a formal investigation involving the accounting team and IT to identify the root cause of the discrepancy, document all findings, and implement a corrective action plan, ensuring compliance with U.S. GAAP and internal control policies. Explanation. The scenario presents a common challenge in financial consolidation and close processes, ensuring data integrity and compliance with reporting standards while dealing with potential system limitations or user errors. The core professional challenge lies in balancing the need for timely and accurate financial reporting with the imperative to adhere to regulatory requirements, specifically those mandated by U.S. GAAP for public companies. The prompt implies a situation where a discrepancy has been flagged, requiring a decisive and compliant resolution. The correct approach represents best professional practice because it prioritizes a systematic, documented, and compliant investigation. By initiating a formal investigation involving relevant stakeholders like the accounting team and IT, and meticulously documenting findings and remediation steps, the organization upholds the principles of internal control and financial reporting integrity. This aligns with the Sarbanes-Oxley Act (SOX) requirements for public companies, which mandate robust internal controls over financial reporting and accurate disclosures. The process ensures that any identified issues are addressed thoroughly, preventing misstatements in financial reports and maintaining investor confidence. This methodical approach is crucial for demonstrating due diligence and compliance with SEC regulations. An incorrect approach that involves immediately overriding the system alert without proper investigation is professionally unacceptable. This bypasses established internal controls and risks masking underlying data integrity issues. From a regulatory perspective, this could be viewed as a failure to maintain adequate internal controls, potentially violating SOX provisions. It also undermines the audit trail, making it difficult to justify financial reporting decisions to auditors or regulators. Ethically, it demonstrates a disregard for accuracy and transparency. Another incorrect approach, such as relying solely on the system's automated correction without human oversight, is also problematic. While automation is valuable, it should not replace critical thinking and professional judgment. If the system's automated correction is based on flawed logic or incomplete data, it could lead to further misstatements. This approach fails to meet the professional standard of ensuring the accuracy and completeness of financial data through diligent review. It also neglects the responsibility to understand the root cause of the discrepancy, which is essential for preventing recurrence and for meeting regulatory expectations for process improvement. The professional reasoning process for such situations should involve a structured approach. 1. Acknowledge and document the alert or discrepancy. 2. Initiate a formal investigation to understand the root cause. This involves engaging the appropriate subject matter experts. 3. Evaluate the impact of the discrepancy on financial reporting considering materiality. 4. Determine and implement appropriate corrective actions, ensuring they are documented. 5. Verify the effectiveness of the corrective actions. 6. Communicate findings and actions to relevant stakeholders, including management and potentially auditors. 7. Update processes or controls to prevent future occurrences. This systematic process ensures compliance, accuracy, and accountability, which are paramount in financial reporting under U.S. GAAP. Question 6. The risk matrix shows a recurring control deficiency in the intercompany reconciliation process within the Oracle Financial Consolidation and Close (FCC) application, specifically related to the timely identification and resolution of discrepancies. Management is considering several approaches to address this. Which approach best aligns with best practices for internal control and regulatory compliance in a U.S.-based financial reporting environment? Option A. Rely on manual journal entries to clear out any remaining reconciliation differences at period end, documenting the manual adjustments. Option B. Implement automated reconciliation rules within FCC to flag and investigate discrepancies in real time, and enhance workflow notifications for timely resolution. Option C. Increase the frequency of manual review of reconciliation reports by senior management to compensate for the system's limitations. Option D. Document the control deficiency in the risk matrix and monitor its recurrence in subsequent periods without immediate remediation. The correct answer is B. Implement automated reconciliation rules within FCC to flag and investigate discrepancies in real time, and enhance workflow notifications for timely resolution. Explanation. This scenario presents a common challenge in financial consolidation and close processes, balancing the need for timely and accurate reporting with the inherent risks of data integrity and control effectiveness. The professionally challenging aspect lies in identifying the root cause of control deficiencies and implementing sustainable solutions that align with regulatory expectations for internal controls over financial reporting. A deep understanding of the Oracle Financial Consolidation and Close (FCC) solutions capabilities, coupled with a robust internal control framework, is crucial. The correct approach represents best professional practice because it prioritizes a systematic and evidence-based evaluation of control effectiveness. By leveraging the FCC system's audit trails and workflow capabilities, the finance team can objectively assess the impact of the identified control gaps. This aligns with the principles of Sarbanes-Oxley, SOX, Section 404, which mandates management's assessment of internal controls over financial reporting. A proactive approach to remediation, involving process redesign and system configuration within FCC, ensures that controls are not only documented, but also effectively implemented and monitored, thereby reducing the risk of material misstatement. An incorrect approach that focuses solely on compensating controls without addressing the underlying control deficiency is professionally unacceptable. This is because compensating controls are intended to be temporary measures and do not provide the same level of assurance as a well-designed, automated, or manual control. Relying on compensating controls indefinitely can lead to increased manual effort, higher risk of error, and a false sense of security, potentially violating the spirit and letter of regulatory requirements for robust internal controls. Another incorrect approach that involves simply documenting the deficiency without a clear remediation plan fails to meet professional standards. This passive approach neglects the responsibility to ensure the accuracy and reliability of financial reporting. Regulators expect proactive identification and remediation of control weaknesses. A third incorrect approach that involves ignoring the deficiency due to time constraints is a severe ethical and regulatory failure. Financial reporting accuracy and control integrity are paramount. Postponing remediation of control deficiencies can lead to significant financial misstatements, reputational damage, and potential legal repercussions. The professional decision-making process in such situations should involve 1. Thorough understanding of the control objective and the deficiency's impact. 2. Evaluation of the root cause of the deficiency. 3. Identification of potential remediation strategies, considering both process improvements and system enhancements within FCC. 4. Assessment of the effectiveness and sustainability of proposed remediation. 5. Prioritization of remediation efforts based on risk. 6. Documentation of the deficiency, remediation plan, and ongoing monitoring. Question 7. The audit findings indicate a recurring discrepancy in the recognition of subscription-based revenue within the Oracle Financial Consolidation and Close (FCC) system, specifically concerning the timing of revenue release based on contract terms. The auditors have flagged this as a potential violation of ASC 606 principles. As an implementation consultant, what is the most appropriate course of action to address this issue? Option A. Inform the client that the current system configuration is standard, and that the auditor's interpretation of ASC 606 may be overly strict for their business model. Option B. Reconfigure the revenue recognition rules within the FCC system to accurately reflect the 5-step model of ASC 606, ensuring that revenue is recognized as performance obligations are satisfied. Option C. Advise the client to manually adjust the revenue figures in the financial statements each period to correct the timing discrepancies identified by the auditors. Option D. Focus on improving data entry training for the finance team to prevent future input errors that may be contributing to the timing issues. The correct answer is B. Reconfigure the revenue recognition rules within the FCC system to accurately reflect the 5-step model of ASC 606, ensuring that revenue is recognized as performance obligations are satisfied. Explanation. The audit findings indicate a potential misstatement in the financial statements due to an incorrect application of revenue recognition principles. This scenario is professionally challenging because it requires a deep understanding of both accounting standards and the specific business processes within the organization. The implementation consultant must not only identify the technical accounting issue, but also assess the root cause within the Oracle Financial Consolidation and Close (FCC) system, and propose a solution that ensures compliance and data integrity. The challenge lies in balancing the need for accurate financial reporting with the practicalities of system configuration and business operations. The correct approach represents best professional practice because it prioritizes adherence to the relevant accounting standards, which in this case would be US GAAP, as the exam is US-centric and does not specify otherwise. Specifically, it involves a thorough review of the revenue recognition criteria as defined by ASC 606, revenue from contracts with customers. This includes analyzing the 5-step model, identify the contract, identify the performance obligations, determine the transaction price, allocate the transaction price, and recognize revenue when, or as, the entity satisfies a performance obligation. The consultant must then map these principles to the FCC system's configuration, data inputs, and processing logic to identify where the deviation occurred, proposing a solution that involves reconfiguring the system to accurately reflect the application of ASC 606, potentially through adjustments to the chart of accounts, rules, or data loading processes, ensures that future financial reporting will be compliant. This approach demonstrates professional integrity by prioritizing accurate financial reporting over expediency. An incorrect approach that involves simply adjusting the reported revenue figures without addressing the underlying system configuration or process failure is professionally unacceptable. This is because it masks the systemic issue, leading to recurring misstatements and a lack of transparency. Ethically, this approach is deceptive as it presents an inaccurate financial picture. From a regulatory perspective, it violates the principles of accurate financial reporting and could lead to non-compliance with SEC regulations and Sarbanes-Oxley requirements for internal controls over financial reporting. Another incorrect approach, which is to ignore the audit finding and assume the current system configuration is correct, is also professionally unacceptable. This demonstrates a failure to exercise due professional care and a disregard for audit recommendations. It implies a lack of commitment to financial reporting accuracy and could lead to significant financial penalties and reputational damage if the misstatement is material. This approach fails to uphold the ethical obligation to act in the best interest of the stakeholders by ensuring reliable financial information. A third incorrect approach, which is to blame the end users for data input errors, without investigating potential system design flaws or inadequate training is also professionally unsound. While user error can be a factor, a responsible consultant would conduct a comprehensive investigation to determine if the system's design or the training provided contributed to the errors. Failing to do so is a dereliction of duty and prevents the identification of systemic improvements that could prevent future issues. This approach can lead to an adversarial relationship with the client and does not foster a culture of continuous improvement. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the audit finding. Fully comprehend the nature and potential impact of the audit finding. 2. Identify the applicable regulatory framework. Determine the relevant accounting standards and regulations, e.g., U.S. GAAP, SEC rules. 3. Analyze the root cause. Investigate the underlying reasons for the discrepancy, considering system configuration, business processes, data inputs, and user actions. 4. Evaluate system capabilities. Assess how the Oracle FCC system is configured and whether it supports the correct application of the identified standards. 5. Propose compliance solutions. Develop remediation strategies that align with regulatory requirements and best practices. 6. Document the process. Maintain thorough records of the investigation, analysis, and proposed solutions. 7. Communicate effectively. Clearly articulate findings and recommendations to stakeholders, including management and auditors. Question 8. The efficiency study reveals that the period-end close process is consistently delayed due to challenges in reconciling intercompany balances within the Oracle financial consolidation and close system. What is the most effective strategy to address this recurring issue? Option A. Allocate additional overtime hours to the finance team to manually clear all outstanding intercompany items before the close deadline. Option B. Adjust intercompany balances directly in the system to meet the close deadline, deferring detailed investigation to a later period. Option C. Implement enhanced data validation rules and automated reconciliation workflows within Oracle FCC, coupled with a clear escalation process for unresolved discrepancies. Option D. Focus solely on reducing the number of intercompany accounts to simplify the reconciliation process, without addressing the underlying causes of discrepancies. The correct answer is C. Implement enhanced data validation rules and automated reconciliation workflows within Oracle FCC, coupled with a clear escalation process for unresolved discrepancies. Explanation. The efficiency study reveals a significant bottleneck in the period-end close process, specifically related to the reconciliation of intercompany balances. This scenario is professionally challenging because it directly impacts the accuracy and timeliness of financial reporting, which are critical for regulatory compliance and stakeholder confidence. The pressure to expedite the close process can lead to shortcuts that compromise data integrity. The correct approach involves a systematic review of the intercompany reconciliation process, identifying root causes of discrepancies, and implementing process improvements within the Oracle financial consolidation and close FCC system. This might include enhancing data validation rules, automating reconciliation tasks where feasible, and establishing clear ownership and escalation procedures for unresolved differences. This approach represents best professional practice because it addresses the underlying issues rather than just the symptoms. It aligns with the principles of robust internal controls and accurate financial reporting, which are implicitly mandated by regulatory frameworks that require reliable financial statements. By focusing on process improvement and system configuration, it ensures that the reconciliation is performed accurately and efficiently, thereby supporting compliance with reporting standards. An incorrect approach would be to simply increase manual effort or extend working hours for the finance team to clear outstanding intercompany items without investigating the source of the discrepancies. This is professionally unacceptable as it does not address the systemic issues causing the delays and errors. It increases the risk of human error and burnout, and it fails to provide a sustainable solution. Ethically, it can be seen as a failure to implement effective internal controls, which could lead to misstated financial reports. Another incorrect approach would be to ignore or minimize the impact of intercompany discrepancies, assuming they will eventually resolve themselves or are immaterial. This is a direct violation of the principle of accurate financial reporting. Regulatory bodies expect all material balances to be reconciled and explained. Failing to do so can lead to audit qualifications and regulatory penalties. This approach demonstrates a lack of professional diligence and in disregard for the integrity of financial data. A third incorrect approach would be to implement a quick fix within the FCC system that masks the discrepancies without resolving them, such as adjusting balances without proper documentation or justification. This is ethically unsound and professionally negligent. It creates a false sense of accuracy, potentially leading to significant issues down the line when the underlying problems surface. It undermines the trust placed in the finance function and can have severe legal and financial repercussions. The professional decision-making process for similar situations should involve a structured problem-solving methodology. First, thoroughly understand the problem by gathering data and analyzing the current process. Second, identify the root causes of the inefficiencies or discrepancies. Third, brainstorm and evaluate potential solutions, considering their impact on accuracy, efficiency, and compliance. Fourth, implement the chosen solution, which may involve system configuration, process changes, or training. Finally, monitor the effectiveness of the implemented solution and make adjustments as needed. This iterative approach ensures that solutions are robust, sustainable, and aligned with professional standards and regulatory requirements. Question 9. Assessment of the most effective strategy for integrating a newly acquired subsidiary with a significantly different chart of accounts into the parent company's Oracle Financial Consolidation and Close Cloud Service (FCCS) environment, considering the need for accurate consolidated reporting. Option A. Develop a comprehensive mapping document that translates the subsidiary's chart of accounts to the parent company's chart of accounts, ensuring alignment with reporting requirements and maintaining data integrity. Option B. Ignore the subsidiary's chart of accounts and only consolidate the net change in equity for the subsidiary. Option C. Directly import the subsidiary's chart of accounts into FCCS and instruct users to manually adjust entries during the consolidation process. Option D. Create a simplified, high-level chart of accounts for the subsidiary within FCCS, aggregating most of its accounts into a few broad categories. The correct answer is A. Develop a comprehensive mapping document that translates the subsidiary's chart of accounts to the parent company's chart of accounts, ensuring alignment with reporting requirements and maintaining data integrity. Explanation. Scenario analysis. This scenario presents a common implementation challenge in financial consolidation, where a newly acquired subsidiary operates under a different chart of account structure than the parent company. The challenge lies in ensuring accurate and compliant consolidation without compromising the integrity of financial reporting or introducing unnecessary complexity. The need to map disparate accounts while adhering to the parent's reporting standards and potentially to specific regulatory requirements. Though none are explicitly stated for this exam's jurisdiction, the principle of compliance remains, demands a structured and well-reasoned approach. The risk of misstatement, regulatory noncompliance, and inefficient reporting processes makes careful judgment paramount. Correct approach analysis. The correct approach involves a detailed analysis of the subsidiary's chart of accounts and a strategic mapping to the parent company's chart of accounts. This mapping should be documented thoroughly, with clear justifications for each account translation. This process ensures that financial data from the subsidiary is accurately represented within the consolidated financial statements, adhering to the parent's reporting framework and any applicable accounting standards. This methodical approach minimizes the risk of errors, facilitates auditability, and supports consistent financial reporting, which are fundamental to professional practice in financial consolidation. Incorrect approaches analysis. One incorrect approach is to simply overlay the subsidiary's chart of accounts onto the parent's without any mapping or translation. This would lead to a chaotic and uninterpretable consolidated view, rendering the consolidation process meaningless and the resulting financial statements inaccurate and non-compliant with reporting standards. Another incorrect approach is to arbitrarily assign subsidiary accounts to the closest parent account without proper analysis or documentation. This introduces a high risk of misclassification, leading to material misstatements in the consolidated financial statements and potential regulatory scrutiny. A third incorrect approach is to ignore the subsidiary's chart of accounts entirely and force all its transactions into a few broad parent accounts. This sacrifices the granularity and detail necessary for meaningful financial analysis and reporting, and fails to accurately reflect the subsidiary's financial performance and position. Professional reasoning. Professionals should approach this challenge by first understanding the reporting requirements of the parent company and any relevant accounting standards. A thorough review of both the parent and subsidiary charts of accounts is essential. The next step is to develop a clear mapping strategy, documenting each translation and its rationale. This strategy should be reviewed and approved by relevant stakeholders. Finally, the implementation should be tested rigorously to ensure accuracy and compliance before going live. This systematic and documented approach ensures data integrity, auditability, and adherence to professional and regulatory expectations. Question 10. Comparative studies suggest that organizations often face resistance when transitioning from manual to automated financial consolidation processes. In the context of implementing Oracle Financial Consolidation and Close (FCCS) for intercompany eliminations, what is the most effective strategy to address a client's deep-seated reliance on their existing, albeit manual, elimination procedures, while ensuring compliance and maximizing system benefits? Option A. Advise the client to continue performing all intercompany eliminations manually outside of FCCS, relying on the system only for reporting. Option B. Replicate the client's existing manual intercompany elimination process within FCCS using custom rules and journal entries to minimize disruption. Option C. Mandate an immediate and complete switch to fully automated intercompany eliminations in FCCS, requiring the client's finance team to adapt rapidly. Option D. Implement a phased approach to automate intercompany eliminations within FCCS, starting with a pilot group or specific account types, allowing for iterative refinement and user training. The correct answer is D. Implement a phased approach to automate intercompany eliminations within FCCS, starting with a pilot group or specific account types, allowing for iterative refinement and user training. Explanation. Scenario analysis. This scenario presents a common implementation challenge in financial consolidation where the client's existing, albeit manual, process for intercompany eliminations is deeply ingrained. The challenge lies in balancing the efficiency and control offered by Oracle FCCS automated capabilities against the client's resistance to change, driven by familiarity and perceived risk of disruption. The professional challenge is to guide the client towards a solution that leverages the system's strengths while respecting their operational realities and ensuring compliance with financial reporting standards. This requires not just technical expertise, but also strong change management and communication skills. Correct approach analysis. The correct approach involves a phased implementation of automated intercompany eliminations within Oracle FCCS. This strategy represents best professional practice because it acknowledges the client's current state and gradually introduces system-driven processes. By starting with a pilot or a subset of intercompany accounts, the implementation team can demonstrate the accuracy and efficiency of FCCS, build client confidence, and allow for iterative refinement of the configuration. This aligns with regulatory expectations for accurate financial reporting by ensuring that eliminations are performed consistently and compliantly, reducing the risk of manual errors that could lead to misstatements. It also fosters user adoption by making the transition less overwhelming. Incorrect approaches analysis. Forcing a complete, immediate switch to fully automated intercompany eliminations without adequate preparation or client buy-in represents a significant regulatory and ethical failure. This approach risks overwhelming the client's finance team, leading to errors in data input or reconciliation, which could result in non-compliance with accounting standards and potentially inaccurate financial statements. Ethically, it disregards the client's operational capacity and expertise, creating an environment where the system is not effectively utilized, undermining the integrity of the financial close process. Another incorrect approach is to replicate the client's existing manual elimination process within FCCS using custom rules or journal entries. While seemingly accommodating, this approach fails to leverage the core benefits of FCCS, such as automated matching and elimination, thereby perpetuating inefficiencies and increasing the risk of manual errors. This is professionally unsound as it misses the opportunity to improve controls and accuracy, potentially leading to non-compliance with the principle of using best-in-class financial consolidation tools for robust reporting. It also fails to deliver the expected return on investment for the system. Finally, abandoning the automation of intercompany eliminations altogether and relying solely on manual adjustments outside of FCCS is a clear abdication of professional responsibility and a direct contravention of best practices for financial consolidation. This approach introduces a high degree of risk for errors, inconsistencies, and a lack of audit trail, making it impossible to ensure compliance with financial reporting regulations. It also negates the purpose of implementing a sophisticated consolidation tool like FCCS. Professional reasoning. Professionals should approach such implementation challenges by first conducting a thorough assessment of the client's current processes and identifying key pain points and areas for improvement. This should be followed by a collaborative design phase, where the benefits of FCCS automated functionalities are clearly communicated and demonstrated. A phased rollout strategy, incorporating user training and change management, is crucial. The decision-making process should prioritize accuracy, compliance, efficiency, and user adoption, always aligning with the principles of sound financial reporting and the capabilities of the chosen system. Question 11. Quality control measures reveal that during the implementation of Oracle Financial Consolidation and Close, a consultant has identified a significant discrepancy in historical data that, if not corrected, could lead to a material misstatement in the consolidated financial statements. The client's project manager, eager to meet the go-live deadline, has indicated a preference to address it later, after the system is live. What is the most appropriate course of action for the consultant? Option A. Inform the client's project manager that the discrepancy is minor and unlikely to have a material impact, suggesting they can address it at their convenience after the system is live. Option B. Document the discrepancy and its potential impact, then formally present the findings and recommended corrective actions to the client's designated project lead or finance executive, and if unresolved, follow the agreed-upon escalation procedures. Option C. Immediately cease the implementation and report the discrepancy to the relevant financial regulatory authority, as the integrity of financial reporting is paramount. Option D. Proceed with the implementation as planned, making a mental note to revisit the discrepancy after the system goes live, to avoid jeopardizing the project timeline and client relationship. The correct answer is B. Document the discrepancy and its potential impact, then formally present the findings and recommended corrective actions to the client's designated project lead or finance executive, and if unresolved, follow the agreed-upon escalation procedures. Explanation. Scenario analysis. This scenario presents a common ethical dilemma in financial reporting where a consultant, tasked with implementing a new consolidation system, discovers a potential misstatement that could impact the reported financial position. The challenge lies in balancing the consultant's duty to the client with their professional obligation to ensure the accuracy and integrity of financial information. The pressure to complete the project on time and within budget, coupled with the client's potential desire to downplay the issue, creates a complex situation requiring careful ethical navigation. Correct approach analysis. The correct approach involves escalating the discovered issue through appropriate channels within the client organization, adhering to professional standards and the Oracle Financial Consolidation and Close implementation guidelines. This means documenting the findings thoroughly, discussing them with the designated client contact, e.g., project manager or finance lead, and if unresolved, following the established escalation path outlined in the engagement letter or professional ethics codes. This upholds the principle of professional skepticism and ensures that potential misstatements are addressed transparently and systematically, preventing the dissemination of inaccurate financial data. This aligns with the ethical obligations of consultants to act with integrity and competence, and to protect the public interest by promoting reliable financial reporting. Incorrect approach is analysis. One incorrect approach involves ignoring the discrepancy to avoid delaying the project or upsetting the client. This is a direct violation of professional ethics, specifically the principles of integrity and objectivity. It could lead to the client filing materially misstated financial reports, potentially breaching regulatory requirements and exposing both the client and the consultant to significant legal and reputational risks. Another incorrect approach is to immediately report the discrepancy to external regulatory bodies, without first attempting to resolve it internally with the client. While transparency is crucial, bypassing the client's internal review process can be seen as unprofessional and may damage the client relationship unnecessarily. It also fails to give the client an opportunity to investigate and correct the issue themselves, which is often the preferred first step. A third incorrect approach is to subtly hint at the discrepancy without providing clear documentation or a direct recommendation for correction. This lacks the necessary professional rigor and can be misinterpreted or dismissed by the client. It fails to meet the consultant's obligation to clearly communicate findings and their implications, leaving the client without actionable information and potentially perpetuating the misstatement. Professional reasoning. Professionals must adopt a systematic approach when encountering potential financial misstatements. This involves 1. Maintaining professional skepticism and critically assessing all information. 2. Thoroughly documenting any discrepancies, including their potential impact. 3. Communicating findings clearly and professionally to the appropriate client personnel. 4. Following established escalation procedures if the issue is not adequately addressed. 5. Adhering to professional codes of conduct and relevant regulatory frameworks throughout the process. This structured decision-making process ensures that ethical obligations are met, client relationships are managed appropriately, and the integrity of financial reporting is preserved. Question 12. Cost-benefit analysis shows that implementing a new data validation rule within the Oracle Financial Consolidation and Close Cloud service for a specific intercompany account will require significant consultant hours and delay the go-live date by 2 weeks. However, the current data for this account is known to be inconsistent, and the proposed rule would significantly improve the accuracy of consolidated financial statements. The client is pushing to bypass the implementation of this specific rule to meet their internal deadlines and has assured the consultant that they will manually reconcile any discrepancies. What is the most appropriate course of action for the implementation consultant? Option A. Implement the data validation rule but document the client's request to bypass it without further discussion, assuming the client understands the implications. Option B. Recommend a simplified version of the validation rule that is quicker to implement, even if it doesn't fully address all potential inconsistencies. Option C. Insist on implementing the data validation rule as per best practices, clearly communicating the risks of not doing so to the client and proposing a phased approach to minimize the go-live delay. Option D. Agree to bypass the data validation rule as requested by the client, documenting their assurance of manual reconciliation to meet the client's deadline. The correct answer is C. Insist on implementing the data validation rule as per best practices, clearly communicating the risks of not doing so to the client and proposing a phased approach to minimize the go-live delay. Explanation. This scenario presents a professional challenge because it pits the desire for efficiency and potential cost savings against the fundamental principles of accurate financial reporting and regulatory compliance. The implementation consultant is faced with a situation where a shortcut, while seemingly beneficial from a cost-benefit perspective, could lead to misrepresentation of financial data and potential breaches of accounting standards. The core of the challenge lies in balancing the client's immediate financial interests with the long-term integrity of their financial statements and adherence to the Oracle Financial Consolidation and Close 2020 implementation guidelines, which are built upon established accounting principles. The correct approach represents best professional practice because it prioritizes data integrity and compliance above all else. By insisting on a thorough validation process, the consultant upholds the principles of accurate financial reporting, which are paramount in any financial consolidation and close process. This aligns with the implicit regulatory framework governing financial reporting, which demands transparency and accuracy. The consultant's commitment to following established procedures, even if they appear more time-consuming or costly in the short term, ensures that the implemented solution will produce reliable financial data, thereby mitigating risks of misstatement and potential regulatory scrutiny. This also reflects the ethical obligation of an implementer to provide a robust and compliant solution. An incorrect approach that suggests bypassing the standard validation for the sake of speed would represent a significant ethical and professional failure. This would violate the principle of due diligence and could lead to the client relying on inaccurate financial data, potentially resulting in misstated financial reports. Such an action could expose both the consultant and the client to regulatory penalties and reputational damage. Another incorrect approach, which might involve accepting the client's assertion of data accuracy without independent verification, demonstrates a lack of professional skepticism and a failure to adhere to best practices in system implementation. This could lead to the perpetuation of underlying data errors within the consolidated financial statements. A third incorrect approach, which might involve documenting the shortcut without addressing the underlying data quality issues, is insufficient as it fails to rectify the root cause of the problem and still leaves the consolidated data vulnerable to inaccuracies. Professionals should employ a decision-making framework that begins with understanding the client's objectives and constraints. However, this understanding must be tempered by a firm commitment to ethical conduct and regulatory compliance. When faced with a conflict, the professional should first identify the core principles at stake, such as data accuracy, compliance, and client benefit. They should then evaluate potential solutions against these principles, seeking to find a path that maximizes client benefit without compromising integrity. If a proposed shortcut appears to offer significant benefits but carries risks to data integrity or compliance, the professional must escalate these concerns, clearly articulate the risks, and propose alternative solutions that uphold the required standards. This involves open communication with the client, explaining the rationale behind the recommended approach and the potential consequences of deviating from it. Question 13. The analysis reveals that a global manufacturing company, operating through multiple subsidiaries in different countries, is experiencing discrepancies in its consolidated financial statements due to uneliminated intercompany sales and purchases. The implementation team is considering how to best address these discrepancies within the Oracle Financial Consolidation and Close (FCC) application to ensure accurate consolidated reporting. Which of the following approaches best aligns with best practices for intercompany eliminations in a consolidated environment? Option A. Develop custom reports outside of FCC to identify intercompany discrepancies and then manually adjust the source system data before the next consolidation cycle. Option B. Manually create journal entries in FCC to eliminate intercompany balances after the initial data load, relying on the finance team's judgment for accuracy. Option C. Configure FCC to automatically identify, match, and eliminate intercompany transactions based on predefined rules and account mappings, ensuring a complete and auditable process. Option D. Implement a process where only intercompany transactions exceeding a certain monetary threshold are identified and eliminated within FCC. Correct answer is C. Configure FCC to automatically identify, match, and eliminate intercompany transactions based on predefined rules and account mappings, ensuring a complete and auditable process. Explanation. The analysis reveals a common challenge in financial consolidation, ensuring the accurate and compliant reporting of intercompany transactions, particularly when dealing with different legal entities within a multinational organization. The scenario is professionally challenging because it requires a deep understanding of both the Oracle Financial Consolidation and Close (FCC) applications capabilities and the underlying accounting principles and regulatory requirements for consolidation. Mismanagement of intercompany eliminations can lead to material misstatements in consolidated financial statements, impacting investor confidence and potentially leading to regulatory penalties. The correct approach, which involves leveraging FCC's automated intercompany reconciliation and elimination functionalities, represents best professional practice. This is because it ensures data integrity, reduces manual error, and aligns with the principles of generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS, the assumed regulatory framework for this exam. Specifically, it adheres to the principle of presenting the consolidated entity as a single economic unit by eliminating transactions that occur solely within the group. This systematic approach minimizes the risk of overstating revenue or assets and understating liabilities. An incorrect approach that relies solely on manual adjustments without utilizing the system's built-in controls presents significant regulatory and ethical failures. It introduces a high risk of human error, inconsistencies, and a lack of audit trail, which is a direct violation of the principles of reliable financial reporting and internal control. Another incorrect approach, which might involve selectively eliminating only certain types of intercompany transactions based on materiality thresholds without a clear policy or justification, fails to meet the comprehensive elimination requirements. This can lead to incomplete and misleading financial statements, potentially violating disclosure requirements and the principle of full transparency. A third incorrect approach, which ignores the need for proper mapping of intercompany accounts within FCC would result in inaccurate elimination entries, directly impacting the accuracy of the consolidated balance sheet and income statement, thereby failing to present a true and fair view. Professionals should adopt a decision-making framework that prioritizes system utilization for core consolidation processes like intercompany eliminations. This involves understanding the business's intercompany transaction flows, configuring FCC to accurately capture and match these transactions, and establishing robust reconciliation processes. The framework should emphasize a thorough review of system-generated elimination, supported by clear documentation and adherence to established accounting policies, ensuring compliance with relevant financial reporting standards. Question 14. The performance metrics show a significant increase in the time taken for the monthly close process within Oracle Financial Consolidation and Close, particularly during the data consolidation and intercompany elimination phases. The system is experiencing intermittent slowdowns, impacting user productivity and the ability to meet reporting deadlines. What is the most appropriate course of action to address this performance degradation? Option A. Focus solely on increasing the server hardware resources, such as RAM and CPU, without investigating the underlying software or process inefficiencies. Option B. Immediately implement a series of aggressive system tuning parameters and database optimizations across all modules to try and force a performance improvement. Option C. Roll back to a previous, known stable version of the Oracle Financial Consolidation and Close application, assuming the recent update caused the issue. Option D. Conduct a detailed analysis of system logs, resource utilization, and specific process execution times to identify the root cause of the performance bottlenecks before implementing any changes. The correct answer is D. Conduct a detailed analysis of system logs, resource utilization, and specific process execution times to identify the root cause of the performance bottlenecks before implementing any changes. Explanation. Scenario analysis. This scenario presents a common challenge in financial close processes where system performance directly impacts the efficiency and timeliness of reporting. The pressure to meet deadlines, coupled with the need for accurate financial data, creates a complex environment. The challenge lies in identifying the root cause of performance degradation and implementing a solution that balances immediate needs with long-term system stability and compliance. A hasty or ill-informed decision can lead to further performance issues, data integrity risks, and potential non-compliance with reporting standards. Correct approach analysis. The correct approach involves a systematic, data-driven investigation into the performance bottlenecks. This aligns with best professional practices in system administration and financial close management. By analyzing the specific metrics and identifying the underlying causes, e.g., inefficient data loading, complex calculations, insufficient hardware resources, the implementation team can develop targeted solutions. This methodical approach ensures that the fix addresses the actual problem, minimizes disruption, and maintains the integrity of the financial data, which is paramount for regulatory compliance and accurate financial reporting. This proactive and analytical method is crucial for maintaining a robust and reliable financial close process, adhering to principles of good governance and internal control. Incorrect approaches analysis. Implementing a broad, untested optimization strategy without understanding the root cause is professionally unacceptable. This approach risks introducing new performance issues or negatively impacting other critical functions within the Oracle Financial Consolidation and Close system. It bypasses the due diligence required to ensure data accuracy and system stability, potentially leading to reporting errors that could have regulatory implications. Applying a solution based solely on anecdotal evidence or a single outlier metric without comprehensive analysis is also professionally unsound. This can lead to misdiagnosis and ineffective remediation, wasting valuable time and resources. Furthermore, it undermines the principle of evidence-based decision-making, which is fundamental to maintaining trust and reliability in financial reporting systems. Ignoring the potential impact of proposed changes on downstream processes or other modules within Oracle Financial Consolidation and Close is a significant ethical and professional failure. A holistic view is necessary to prevent unintended consequences that could compromise data integrity or reporting timelines, thereby risking non-compliance with financial regulations. Professional reasoning. Professionals should approach performance issues by first establishing clear, measurable performance indicators. They should then gather and analyze relevant data to pinpoint the exact cause of the problem. Solutions should be designed with a thorough understanding of their impact across the entire system and its dependencies. Testing and validation are critical steps before full implementation. This structured, analytical, and risk-aware approach ensures that decisions are sound, effective, and uphold the integrity and compliance of the financial close process. Question 15. The performance metrics show a significant increase in the time taken to complete the intercompany reconciliation process. Which of the following approaches would be the most effective and professionally sound method to address this issue within the Oracle Financial Consolidation and Close (FCC) environment? Option A. Conduct a comprehensive root cause analysis of the intercompany reconciliation process. Identify specific bottlenecks and inefficiencies, and implement targeted improvements leveraging Oracle FCC functionalities such as automated matching rules, exception management workflows, and enhanced reporting. Option B. Temporarily suspend certain reconciliation checks and controls to meet the immediate deadline for financial reporting, with a plan to address them in a subsequent period. Option C. Immediately assign additional personnel to the reconciliation team to increase processing capacity and expedite the completion of outstanding reconciliations. Option D. Implement a standardized, off-the-shelf process optimization template across all financial close activities, without a specific analysis of the intercompany reconciliation challenges. The correct answer is A. Conduct a comprehensive root cause analysis of the intercompany reconciliation process, identify specific bottlenecks and inefficiencies, and implement targeted improvements leveraging Oracle FCC functionalities such as automated matching rules, exception management workflows, and enhanced reporting. Explanation. The performance metrics show a significant increase in the time taken to complete the intercompany reconciliation process. This scenario is professionally challenging because delays in reconciliation can lead to inaccurate financial reporting, potential noncompliance with internal controls and external audit requirements, and ultimately impact the timeliness and reliability of financial statements. The pressure to meet reporting deadlines while ensuring accuracy necessitates a strategic approach to process optimization. Correct approach involves a thorough root cause analysis of the reconciliation process, identifying bottlenecks and inefficiencies, and implementing targeted improvements. This aligns with best professional practices in financial close management, emphasizing accuracy, efficiency, and control. Specifically, within the Oracle Financial Consolidation and Close (FCC) context, this means leveraging the system's capabilities for automated matching, exception management, and workflow to streamline the process. This approach ensures that the optimization efforts are data-driven and focused on addressing the actual issues, rather than making superficial changes. It also supports the integrity of financial data, which is a fundamental ethical and professional obligation. An incorrect approach would be to simply increase the resources allocated to the reconciliation team without understanding the underlying process issues. This is professionally unacceptable because it is a reactive and potentially wasteful solution that does not address the root cause of the delay. It could lead to increased operational costs without a commensurate improvement in efficiency or accuracy, and it fails to leverage the technological capabilities of FCC for process improvement. Another incorrect approach is to bypass certain reconciliation steps to meet deadlines. This is a severe regulatory and ethical failure. Bypassing reconciliation steps compromises the accuracy and completeness of financial data, potentially leading to misstatements in financial reports. This violates internal control principles and can result in noncompliance with accounting standards and regulatory requirements. It erodes the credibility of the financial close process and can have significant legal and financial repercussions. A third incorrect approach is to implement a generic, one-size-fits-all optimization solution without considering the specific nuances of the intercompany reconciliation process within the organization and the capabilities of the Oracle FCC system. This is professionally unsound, as it ignores the unique challenges and opportunities for improvement. It may lead to the implementation of solutions that are not compatible with the existing system or do not effectively address the identified bottlenecks, resulting in wasted effort and continued inefficiency. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the problem and its impact using performance metrics. Second, conduct a detailed analysis of the current process, involving stakeholders and leveraging system data. Third, identify potential solutions, prioritizing those that are data-driven, leverage technology, and align with regulatory and internal control objectives. Fourth, implement and test the chosen solutions, continuously monitoring performance to ensure sustained improvement. Finally, document the changes and ensure ongoing training and adherence to the optimized process. Question 16. Consider a scenario where a finance team is under significant pressure to reduce the time taken for the monthly financial close. The team is exploring various methods to achieve this, including the adoption of new technologies and the streamlining of existing workflows. Which of the following approaches best balances the need for efficiency with the imperative of maintaining data integrity and regulatory compliance? Option A. Conduct a comprehensive review of the existing close process to identify bottlenecks and redundancies, followed by a phased implementation of targeted improvements and robust testing. Option B. Prioritize the elimination of all manual journal entries and reconciliations, as these are typically the slowest parts of the close process, without assessing the impact on control activities. Option C. Rely exclusively on recommendations from a third-party software vendor for process re-engineering, without internal validation or consideration of existing control frameworks. Option D. Immediately implement a new, advanced consolidation software solution to automate as many steps as possible, assuming it will inherently improve efficiency and accuracy. The correct answer is A. Conduct a comprehensive review of the existing close process to identify bottlenecks and redundancies, followed by a phased implementation of targeted improvements and robust testing. Explanation. Scenario analysis. This scenario presents a common challenge in financial consolidation and close processes, balancing the need for efficiency with the imperative of maintaining data integrity and regulatory compliance. The pressure to accelerate the close cycle can lead to shortcuts that, while seemingly beneficial in the short term, can introduce significant risks. Professionals must exercise careful judgment to identify and mitigate these risks, ensuring that process optimization efforts do not compromise the accuracy and reliability of financial reporting, which is paramount for stakeholder trust and regulatory adherence. Correct approach analysis. The correct approach involves a systematic review and re-engineering of existing processes, focusing on identifying bottlenecks and redundancies without compromising control activities. This aligns with best professional practices by prioritizing a thorough understanding of the current state, engaging stakeholders to gather insights, and implementing changes in a controlled, phased manner. This methodology ensures that any optimizations are validated for their impact on data accuracy, internal controls, and compliance with relevant financial reporting standards. The emphasis on documentation and testing provides an audit trail and assurance that the optimized process meets all requirements. Incorrect approaches analysis. Implementing automated solutions without a prior process review risks automating inefficient or flawed processes, potentially exacerbating errors and creating new compliance issues. This approach fails to address the root causes of inefficiencies and can lead to a false sense of optimization. Relying solely on the advice of external consultants without internal validation overlooks critical business context and internal control considerations. This can result in solutions that are technically sound but practically unworkable, or that bypass necessary internal checks and balances, leading to potential regulatory breaches. Focusing exclusively on reducing the number of manual steps without assessing the impact on control effectiveness is a significant regulatory and ethical failure. Manual steps often serve as critical control points. Eliminating them without implementing equivalent automated or compensating controls can weaken the overall control environment, increasing the risk of misstatement and noncompliance with financial reporting regulations. This directly undermines the integrity of financial reporting. Professional reasoning. Professionals should adopt a structured approach to process optimization. This involves 1. Understanding the current process, documenting existing workflows, identifying key controls and assessing performance metrics. 2. Identifying opportunities, analyzing data and stakeholder feedback to pinpoint areas for improvement, focusing on both efficiency and control effectiveness. 3. Designing the optimized process, re-engineering workflows, incorporating technology where appropriate, and ensuring that all necessary controls are maintained or enhanced. 4. Testing and validation, rigorously testing the new process to ensure accuracy, reliability, and compliance. 5. Implementation and monitoring, rolling out the optimized process and continuously monitoring its performance and effectiveness. This iterative and control-aware approach ensures that optimization efforts are sustainable and contribute to a robust financial close process. Question 17. The investigation demonstrates a scenario where significant intercompany balances remain unreconciled at the close of the reporting period. The finance team is under pressure to finalize the consolidated financial statements quickly. Which of the following approaches best aligns with the principles of accurate financial consolidation and regulatory compliance within the Oracle Financial Consolidation and Close 2020 Implementation Essentials Framework? Option A. Postpone the investigation and resolution of intercompany discrepancies until the subsequent reporting period to ensure the current period's close is completed on time. Option B. Make manual adjustments to the consolidated trial balance to eliminate the unreconciled balances, assuming they are immaterial to meet the close deadline. Option C. Accept the unreconciled balances as a known issue and disclose them as a contingent liability in the footnotes, without further immediate investigation. Option D. Proactively investigate and resolve all intercompany discrepancies through a structured reconciliation process, documenting findings and adjustments before finalizing the consolidated financial statements. Correct answer is D. Proactively investigate and resolve all intercompany discrepancies through a structured reconciliation process, documenting findings and adjustments before finalizing the consolidated financial statements. Explanation. The investigation demonstrates a common challenge in financial consolidation and close processes, ensuring data integrity and compliance when dealing with intercompany transactions. The scenario highlights the critical need for robust reconciliation procedures and clear communication channels between entities. The professional challenge lies in balancing the speed of the close process with the accuracy and completeness of financial data, especially when discrepancies arise. Adherence to the Oracle Financial Consolidation and Close 2020 Implementation Essentials Framework, which implicitly guides towards best practices in financial reporting and internal controls, is paramount. The correct approach emphasizes proactive identification and resolution of intercompany discrepancies through a structured reconciliation process. This aligns with the principles of accurate financial reporting and internal control, which are fundamental to regulatory compliance. By systematically investigating and resolving differences, the organization ensures that its consolidated financial statements reflect a true and fair view, minimizing the risk of misstatement and potential regulatory scrutiny. This approach fosters transparency and accountability across entities, which are key tenets of sound financial governance. An incorrect approach that relies solely on manual adjustments without thorough investigation risks masking underlying issues. This can lead to inaccurate financial reporting, violating the principle of presenting a true and fair view. It also bypasses the opportunity to identify and rectify systemic problems in intercompany processes, potentially leading to recurring errors and increased audit risk. Another incorrect approach, which involves delaying the resolution of discrepancies until after the close, compromises the timeliness and accuracy of the consolidated financial statements. This can lead to delayed decision-making and potential non-compliance with reporting deadlines. Finally, an approach that prioritizes speed over accuracy by accepting discrepancies without proper validation directly undermines the integrity of the financial data and the reliability of the consolidated results. This can have severe reputational and financial consequences. Professionals should employ a decision-making framework that prioritizes accuracy and compliance. This involves establishing clear reconciliation policies and procedures, utilizing system capabilities for automated matching where possible, and fostering strong communication between accounting teams of different entities. When discrepancies arise, the process should mandate thorough investigation, documentation of findings, and timely resolution before the finalization of consolidated accounts. This systematic approach ensures that the close process is not only efficient, but also robust and compliant. Question 18. Upon reviewing the status of the monthly financial close process, a key executive requests an update on the financial performance and position. The executive is not a finance expert, but needs to understand the significant changes and their implications for the business. Which of the following approaches best addresses this request while adhering to professional standards for financial reporting and stakeholder communication? Option A. Offer a high-level overview of total assets and total liabilities, without detailing any specific account movements or variances. Option B. Present the raw trial balance data for the period, allowing the executive to review all account balances and make their own interpretations. Option C. Provide a summary of the financial close status that highlights key variances from budget or prior periods, along with clear explanations for these significant movements, and confirm the overall accuracy and completeness of the financial statements. Option D. Report on the percentage of closed tasks that have been completed, indicating the progress of the close process from an operational standpoint. The correct answer is C. Provide a summary of the financial close status that highlights key variances from budget or prior periods, along with clear explanations for these significant movements, and confirm the overall accuracy and completeness of the financial statements. Explanation. Scenario analysis. This scenario presents a common challenge in financial consolidation and close processes, balancing the need for timely and accurate reporting with the potential for misinterpretation or manipulation of data by stakeholders with varying levels of financial expertise. The challenge lies in ensuring that the presentation of financial data, particularly during the close process, is transparent, understandable, and adheres to the relevant accounting standards and regulatory requirements without creating undue confusion or providing opportunities for misrepresentation. The pressure to deliver information quickly can sometimes lead to shortcuts that compromise clarity and compliance. Correct approach analysis. The correct approach emphasizes providing a clear, concise, and contextually relevant summary of the financial close status, highlighting key variances and their explanations. This aligns with best professional practices in financial reporting and stakeholder communication. Specifically, it adheres to the principles of transparency and accountability mandated by regulatory frameworks such as those governing public companies, e.g., SEC regulations in the U.S., if applicable to the exam's implied jurisdiction. Providing explanations for significant variances ensures that stakeholders can make informed decisions based on accurate information, preventing misinterpretations that could lead to poor business decisions or regulatory scrutiny. This approach fosters trust and confidence in the financial reporting process. Incorrect approach is analysis, presenting raw, uninterpreted trial balance data without any narrative or explanation is professionally unacceptable. This approach fails to meet the stakeholders' need for understanding and can lead to misinterpretations, potentially violating principles of fair presentation and transparency. It places an undue burden on the stakeholder to perform their own analysis, which they may not be equipped to do accurately, leading to potential errors in judgment. Providing a high-level summary of total assets and liabilities without detailing significant movements or variances is also professionally deficient. While it offers a summary, it lacks the crucial detail needed to understand the drivers of financial performance and position during the close period. This can obscure critical issues and prevent stakeholders from identifying potential risks or opportunities, thereby failing to uphold the duty of providing comprehensive and insightful financial information. Focusing solely on the completion percentage of tasks within the close process, without any reference to the financial impact or accuracy of the data, is a procedural rather than a financial insight. This approach provides no value in understanding the financial health or performance of the entity. It is a superficial metric that does not address the core need of stakeholders to understand the financial outcomes of the period, and thus fails to meet professional standards of financial communication. Professional reasoning. Professionals must adopt a decision-making process that prioritizes clarity, accuracy, and compliance. This involves understanding the audience's needs and tailoring the communication accordingly. The process should include 1. Identifying the core information required by stakeholders. 2. Analyzing the financial data to identify key trends, variances, and their underlying causes. 3. Synthesizing this information into a clear, concise, and actionable narrative. 4. Ensuring that all explanations and summaries are supported by accurate data and adhere to relevant accounting standards and regulatory requirements. 5. Proactively addressing potential areas of confusion or misinterpretation. Question 19. The monitoring system demonstrates an alert indicating a significant variance in intercompany balances for a specific entity during the period-end close process. The variance exceeds the predefined threshold for materiality. What is the most appropriate immediate action for the financial consolidation team? Option A. Initiate a detailed investigation into the source of the intercompany balance variance, tracing transactions and verifying supporting documentation to understand the root cause before proceeding with the close. Option B. Forward the alert to the IT department for them to resolve as a system issue without further immediate action from the finance team. Option C. Apply a manual adjustment to align the intercompany balances, as the close must be completed on time. Option D. Dismiss the alert, assuming it is a transient system anomaly given the tight deadline for financial reporting. The correct answer is A. Initiate a detailed investigation into the source of the intercompany balance variance, tracing transactions and verifying supporting documentation to understand the root cause before proceeding with the close. Explanation. Scenario analysis. This scenario presents a common challenge in financial consolidation and close processes where automated system alerts highlight potential data integrity issues. The professional challenge lies in interpreting these alerts within the context of specific accounting standards and regulatory requirements, ensuring that the close process is not only efficient but also compliant and accurate. The pressure to meet tight deadlines for financial reporting can lead to a temptation to overlook or dismiss alerts without thorough investigation, which is a significant professional risk. Correct approach analysis. The correct approach involves a systematic investigation of the identified data discrepancy. This aligns with best professional practice as mandated by accounting standards and regulatory bodies. Specifically, under U.S. GAAP, which is the assumed jurisdiction for the 1Z0-1081-20 exam, unless otherwise specified. Accountants have a professional responsibility to ensure the accuracy and completeness of financial statements. This includes performing due diligence when system-generated exceptions are flagged. The investigation should involve tracing the data flow, understanding the business logic behind the consolidation rules, and verifying the source data. This methodical approach ensures that any identified errors are corrected, preventing misstatements in the financial reports and maintaining the integrity of the consolidation process. It upholds the principles of professional skepticism and due care. Incorrect approach is analysis. Dismissing the alert without investigation represents a failure to exercise professional skepticism and due care. This could lead to material misstatements in the financial statements, violating the principles of accurate financial reporting. Ethically, it demonstrates a lack of commitment to the accuracy of the financial data. Assuming the alert is a system glitch without verification is also professionally unsound. While system errors can occur, a responsible professional must investigate before making such an assumption. This approach bypasses the necessary controls and could allow genuine data errors to go uncorrected, potentially leading to non-compliance with reporting requirements. Applying a manual override without understanding the root cause of the discrepancy is highly risky. While overrides might be necessary in exceptional circumstances, they should be a last resort and fully documented with a clear rationale. Without understanding the underlying issue, an override could mask a significant problem, leading to incorrect consolidation and reporting. This approach undermines the integrity of the audit trail and the reliability of the financial data. Professional reasoning. Professionals should approach system-generated alerts with a mindset of inquiry. The decision-making process should involve 1. Acknowledging the alert and its potential impact. 2. Initiating a documented investigation to understand the nature and cause of the discrepancy. 3. Consulting relevant accounting standards and internal policies. 4. Collaborating with relevant business units or IT support if necessary. 5. Determining the appropriate corrective action, which may include data correction, process adjustment, or a documented exception. 6. Ensuring that all actions taken are thoroughly documented for audit purposes. This structured approach ensures that financial data is reliable, compliant, and that the consolidation process is robust. Question 20. Examination of the data shows that parent company, reporting under U.S. GAAP, has acquired a subsidiary that uses different revenue recognition policies for long-term service contracts. The parent company's policy is to recognize revenue over the life of the contract, while the subsidiary recognizes revenue upon project completion. Both companies are now part of the same consolidated entity. Which of the following actions is the most appropriate to ensure accurate consolidated financial reporting? Option A. Apply the subsidiary's revenue recognition policy to the parent company's long-term service contracts for the consolidated reporting period. Option B. Consolidate the subsidiary's financial statements as reported, assuming the differences are immaterial. Option C. Only disclose the difference in revenue recognition policies in the footnotes without making any adjustments to the financial statements. Option D. Adjust the subsidiary's financial statements to align with the parent company's revenue recognition policy for long-term service contracts before consolidation. The correct answer is D. Adjust the subsidiary's financial statements to align with the parent company's revenue recognition policy for long-term service contracts before consolidation. Explanation. The scenario presents a common challenge in financial consolidation, where a newly acquired subsidiary's accounting policies differ from the parent company's. The professional challenge lies in ensuring compliance with U.S. Generally Accepted Accounting Principles, U.S. GAAP, while accurately reflecting the subsidiary's financial performance and position within the consolidated statements. This requires a deep understanding of consolidation principles and the ability to identify and address accounting policy differences. The correct approach, which involves identifying and reconciling all material differences in accounting policies between the parent and the subsidiary, represents best professional practice. This aligns directly with the principles of U.S. GAAP, specifically ASC 810, Consolidation, which mandates that consolidated financial statements present the financial position and results of operations of a parent and its subsidiaries as if they were a single economic entity. This requires eliminating intercompany transactions and balances, and crucially, ensuring that all entities within the consolidation use uniform accounting policies. Failure to do so would result in misleading consolidated financial statements, violating the principle of fair presentation. An incorrect approach would be to ignore or inadequately address the accounting policy differences. For instance, simply consolidating the subsidiary's financial statements as is, without any adjustments for differing revenue recognition policies, would lead to an overstatement or understatement of consolidated revenue. This constitutes a violation of U.S. GAAP and professional ethical standards, as it misrepresents the financial performance of the combined entity. Similarly, applying the subsidiary's policies to the parent's results would distort the parent's historical performance and comparability. Another incorrect approach, such as selectively adjusting only the most obvious differences while overlooking others, would result in incomplete and inaccurate consolidation, failing to achieve the objective of presenting a single economic entity. This demonstrates a lack of due diligence and adherence to accounting standards. Professionals should employ a structured decision-making framework when faced with such situations. This framework typically involves 1. Understanding the reporting requirements, U.S. GAAP in this case. 2. Identifying all entities to be consolidated. 3. Analyzing the accounting policies of each entity. 4. Identifying and quantifying material differences in accounting policies. 5. Developing and implementing a plan to reconcile these differences to a uniform set of policies. 6. Documenting the reconciliation process and the rationale for policy choices. 7. Reviewing the consolidated financial statements for accuracy and compliance. This systematic approach ensures that all relevant factors are considered and that the consolidated financial statements are reliable and compliant.